Order, order. Welcome to the Treasury Select Committee on Tuesday, the 25th of March 2025. Today we are having one of our regular sessions with the Financial Conduct Authority, the FCA, to discuss all aspects of the FCA's work, including some of the issues around consumers and, of course, the government's plans for growth and changes in regulators. There's a lot to get through this morning, so it's a bit of a smorgasbord of the work, and we're delighted to welcome our witnesses. Alder is the chair of the Financial Conduct Authority. Nikhil, Rathi is the chief executive of the FCA, and Sheree is an executive director, particularly dealing with authorisations. So a warm welcome to you all. And I'm going to ask Dr. Jeevan Sander, MP, to kick off. Mr. Sander.
Thank you, Chair. Mr. Rathi, you recently advised the FCA staff they needed a change in mindset. Why is this change needed in your view?
We have an urgent problem in the UK, and that's our stagnant growth rate. And that has an impact on living standards, that has an impact on how businesses can create jobs, and we as the largest economic regulator have a role to play in supporting the strategic direction of the government in driving growth in the economy. We have worked incredibly hard over the period of the last 3-year strategy to make sure we have firm foundations for the future with higher standards, a strong operational platform, a preventative approach to tackling consumer harm. And it's right now that with the strategic direction being set by the government for all regulators in the UK, that we as the largest regulator swing behind that and play our part.
So picking up on this day, I think it's in the balance is the shift towards, if you like, being a bit more, or a bit less restrictive. You've spoken also to your letter to the Prime Minister about tolerable failures, and I'm assuming this is about the idea of, for example, an increase in defaults that would happen if you were to increase lending. I wonder if, given your remarks also about a change in mindset, you're worried about tolerable failures in the other direction. So, for example, where people can't get access to the capital they need because of the current regulatory environment.
We're launching our 5-year strategy today, and we say in that we want to rebalance our approach to risk so that we can support consumers and the economy. We recognise that we have to prioritise. We have to prioritise our resources. We have to make judgments about risk trade-offs, and often there are no right judgments here. We have to balance a range of different factors in our decision-making. And what I wrote to the Prime Minister with our 50 or so proposals to support competitiveness and growth at the start of the year was to say there are many things we can do, and we are operating now at very considerable pace in delivering those proposals. What's important for us as we do that is to have as broad a consensus as we can, including in Parliament, and this committee is our primary mechanism of accountability in Parliament, about what the appropriate risk appetite is and how we balance those trade-offs. I've cited the mortgage example, where there clearly is an issue in the United Kingdom when people who are paying high rents cannot get onto the housing ladder, and we can adjust the lending standards to support more first-time buyers. That is not going to be entirely consistent with maintaining the same level of defaults over time in the economic cycle. And there are choices there to be made. And we want to have that debate. We want to have the debate around innovation. We can allow more innovative firms into the market, and Sheree may talk about this later when it comes to authorisations. And we want to allow some experimentation, but we also need to be able to get them out if things aren't working well. And you're quite right, there's also a point around tolerable failure in the other direction, which is if we take too restrictive an approach, that can mean, for example, that savers and investors are not getting the long-term returns they need for secure retirements and long-term financial well-being. We see that in the UK with several £100 billion in easy access accounts or no interest accounts, which money that's actually not needed for transactional purposes or liquidity purposes just being held there. And that's quite a different picture to the United States, Canada or Australia. And that's not good for our citizens.
No, also you picked up on the mortgage example, which I think is interesting, because also I think in your letter to the Chancellor you spoke about reforms to the mortgage market, you spoke about helping young people get on the housing ladder, you spoke a lot today about growth. I suppose specifically, what are the changes you're envisaging to the regulation around mortgage lending to increase first-time home ownership and presumably growth through house building?
We have set out earlier this month what the flexibility is that is available under our current rules. Already, lenders can exercise judgment as to how they do the stress test, and we think that some may be being too cautious at the moment in the level of interest rate they're stressing against. So that was the first step we've taken, and we've taken that step immediately. We have also issued a call for evidence from lenders and from consumer groups as to how we may be able to adjust the stress test. So let me give you an example. We know that rents are very high in many parts of the country, and people may be demonstrably able to pay those high rents, and they manage to sustain their finances in doing so. And yet, if their monthly mortgage payment is somewhat lower than that rent, that might still not meet some of the affordability tests that are there. We have to ask the question, is that a sensible position for us to be in, or do we need to show a little bit more flexibility in that area? We are also looking at retiring some of our redundant guidance on interest-only mortgages because we now have the consumer duty in place. We know that later life lending and as house prices have increased, more people need to borrow potentially right up to retirement or beyond retirement. How can we ensure that in a flexible and pragmatic way? And then finally, technology. We have a regulated advice process, but we see some lenders coming to us and saying, can we move to a fully digital advice process? Our rules currently don't make that easy, so in the sandbox, we're going to experiment and see if we can make that possible.
So on that, to kind of end where I started to some extent, there's a cultural change around the FCA of being more pro-growth in the sense that having more lending or less restrictive environment to get capital where it's needed. And you spoke a bit about some of the specific rule changes, but also I think also about a culture change within the industry. So when you talk about a change in mindset and the culture of the FCA, are you also saying fundamentally to financial institutions, it's also for you to step forward and think about how you can, for example, increase lending or get capital to where it's needed?
We all need to move together. I think from the government perspective, there's also an important dimension around this, which relates to housing supply. And it wouldn't be sensible for us to adjust the lending standards too far on mortgages if the supply isn't coming through, because that will simply lead to higher house prices and perhaps not deliver the outcomes we're seeking. It requires industry, yes, to adjust, and they need the confidence that the rules permit them to do that. I would also respectfully say it also needs a good discussion here in Parliament as well. 18 months ago, when we introduced the Mortgage Charter, or supported the introduction of the Mortgage Charter, which the government of the day introduced, the general consensus in Parliament from pretty much every major party was keep repossessions down. And we've done that. And we have, in the last quarter, about 1,000 repossessions, which is very low relative to history, even more so given the scale of the interest rate rises. And but what we do see, as we've brought those repossessions down, and as lenders have delivered significant forbearance, we have the highest number ever of accounts that are in arrears of greater than 10% of the balance. So there are trade-offs here when you make these choices, because what's happening is people are being kept in their homes, but the balances are accruing. And that debate around risk culture, I think, is really important here in Parliament too, so that we are as aligned as we can be as we take forward these changes.
Thank you. Chair.
Thank you very much, Dr. Sando. Bobby Dean MP.
Thank you. I'd like to probe a bit further about, I think, the perceived distance between what the government are saying and what the regulator's response has been. So we've got quotes from the Prime Minister about regulation will be cut back and that regulators are leading to bloating and blocking of growth. We've got the Chancellor saying that the regulatory system's become too burdensome and described their agenda as deregulatory. But in comments I've seen from you, it seems to be more measured than that. I saw you said that you've long contributed to growth and this is more about simplifying rules whilst maintaining high standards. Do you think there is a gap between the government's ambition on this agenda and what the regulators are prepared to do?
Regularly with the government, and I speak to the Chancellor regularly. I was at her round table with regulators on Monday last week, and I think there's a good degree of alignment. The government chooses its words. We choose our words in terms of how we take forward our work, and we're always going to be anchored to the primary objectives that Parliament has given us. You've given us primary objectives around consumer protection, market integrity and competition in the interest of consumers, and you've asked us to pursue growth and competitiveness insofar as we can also deliver those primary objectives. So that will always be our anchor. And what we're saying is we entirely recognise that we play a role in different ways in supporting growth. Firstly, and I hear this most from firms, what they want from us is predictable, proportionate regulation. They want speed, clarity and certainty, particularly in authorisations. Over 99% of our authorisations are now delivered within statutory timelines. We're digitising our forms. We're moving faster to support early and high growth firms and providing dedicated case officers to those firms in our regulatory sandbox. They would like us to be thoughtful about data requests. We need data to be able to do our job. The level of risk out there, particularly on our wholesale markets work, is some of the highest levels ever. And sometimes we need more data and more real time. But we also need to accept that sometimes some of our data returns might be redundant. And we'll be consulting soon on retiring 3 redundant data returns that will benefit 16,000 firms. That's an example of an administrative cost that we can relieve to appoint a Prime Minister.
If I could come back in though. Again, that's to me sort of, tidying up the number of data requests, stopping there being overlap where there's overlap. It seems like a tidying up exercise as opposed to the deregulatory agenda that the Chancellor described. Is your response to this in part a warning to the government that we shouldn't go too far on this and we've got hard-won stability as a result of our response to the 2008 crash and we shouldn't be looking to throw some of that away?
We're in a different world to 2008, and I was very involved in the work during the financial stability crisis in 2008 and the response that followed. We have significantly raised standards both on the prudential side and the conduct side. We now have the consumer duty in the UK, which we embedded over the last 2 years, which has raised standards for retail financial services protection. We always said when we implemented the consumer duty that once it was done, there would be less rules in the future, and we meant it. And that's why we've published today some of our first thoughts on how we can simplify some of our rules. We also recognise we're in a different economic environment and a different risk environment and a different technological environment, and regulation needs to move fast to make sure that we are keeping pace with the developments that we see around us. And some of our rule changes are very far-reaching. Some will be more moderate. On listings and on prospectus reform, we've put through some of the most far-reaching rule changes in our capital markets for many, many decades. Our advice guidance biannual review is described, I think, by the industry as potentially transformative by enabling targeted support to be provided to the mass market in a way that's not possible today. In other areas, it will be more modest and more streamlined. In all of this, what we want to do is have a good, healthy debate about the risk and the trade-offs so that there's a good understanding that with the potential for innovation, opportunity and growth, 1 or 2 more things may go wrong. And we're not going to be able to stop everything, but that might be a price worth paying for the broader benefits to society and the economy.
Yeah, I mean, on that point, your submission to the Lord's Financial Services Regulation Committee was interesting, and there's a sort of table of potential trade-offs, and a lot of them talk about setting boundaries for, say, consumers in financial distress does not grow by more than X%, and they're all kind of written in these terms. Read another way, it could seem like you're saying that we need to accept more harm, more complaints, more claims, more frauds, more insolvencies, less competition, less confidence, and so on, in exchange for this deregulatory approach towards growth. Is that what you're saying to Parliament, that we're going to see more of all of these things and you need to tolerate that if we want to achieve growth?
What I'm saying is there are choices here, and we need to have an open evidence-based debate around those choices. Dr. Sanders just asked me about mortgages. We can relax lending standards, and we intend to, subject to consultation, to enable more first-time buyers to come into home ownership. We can't do that at the same time as saying there'll be less defaults. There's a choice there. One of the biggest challenges we get from the industry is the cost of the financial crime controls and the regulatory controls around sanctions and money laundering. A very large component of that actually comes from statute, and we're implementing the laws as passed by Parliament. Several £billion of cost to the industry. There are ways which we can, working with the government, look at modifying some of those to be more proportionate, to allow the deployment of new technology, to be forward-leaning in tackling harm. But in doing that, we can't guarantee that 1 or 2 more money mules aren't going to get through the system. On innovation, I talked about the digital sandbox. We're looking at a new platform for trading private market securities with some more flexibilities. Can I guarantee that not everybody, that somebody isn't going to abuse those new flexibilities? I can't guarantee that. But we think that enabling more people to be able to raise and access capital as they move from private to public will overall generate benefits. And so I am saying that if we want to support innovation growth and generate these benefits, let's have a debate about what the potential risks may be. And I think we've always struggled to some extent at the FCA of having that debate, and I'm really grateful that the committee is giving us an opportunity to surface some of this now.
So I guess what some consumers and maybe smaller businesses might ask then is, why is there this trade-off? Like, who is this growth for if, in order to achieve growth, we need to accept more consumer harm and potentially less competition in the market?
Ultimately, it's for all of our citizens and businesses. We have to face the fact that since 2012, the productivity gap between the United Kingdom and the United States has more than doubled. And that has impact on wealth generation, that has impact on living standards. And one of the points I was making in my remarks to my colleagues last week is we have to test ourselves, are we really delivering our consumer protection objective in the long term if we aren't openly facing into the fact that consumer protection in the short term might undermine financial well-being in the long term. You see that, for example, in terms of investment in pensions, where we perhaps have a lower risk overall allocation of our enormous pension wealth relative to what happens in the United States, Canada, Australia, or other markets. At the same time, we're struggling to find private capital to invest in infrastructure and private capital to invest in our growth and scale-up companies. In fact, Australian and Canadian pension funds seem to find investments in the UK more attractive than our own pension funds. And their pensioners are getting the benefits of those returns. We have to ask ourselves, is that really a sensible long-term solution for our society?
Thank you.
Thank you very much. John.
Yes, I've got two questions. The first one is about the PSR. 10 years ago, the PSR was created to enable growth. Now it looks like it's been folded into the FCA to enable growth. How do you see the movement in the PSR's status as an independent entity is going to practically facilitate the sorts of contribution to growth enablement that you've been talking about?
I've always said at this committee, over the years I've been here, that the structure of regulation, the architecture of regulation, is a matter for government and Parliament. It's our job as the FCA to implement those decisions. First and foremost, and I know you met the PSR leadership recently, I think that I would say how proud PSR colleagues can be of everything they've achieved in their time on APP fraud, on open finance, on delivering innovation in the payments architecture. The PSR works incredibly closely with us already. We received a joint remit letter from the Chancellor. It's a subsidiary of the FCA. They're employees of the FCA on FCA contracts. We have a joint staff committee, and there's much that we do in a joined-up way. As payments has evolved over the recent years, with dramatic innovations happening, there is a natural evolution here to bring us into line with what happens in other major jurisdictions, to bring a degree of greater coherence. And I can entirely understand the sentiment from this committee that somehow the work of the PSR, which is critical, might get lost in a large organisation like the FCA, and I want to give you some assurance that we are determined to make sure that doesn't happen, and we'll cooperate with whatever scrutiny arrangements you'd like to put in place to assure yourselves of that too.
I suppose the question is, when I was minister and I went abroad, the FCA has a reputation as world class. When I come back home, it's less so. And the stakeholders would always challenge me that there are issues, some of which you've been talking about this morning. One of the things we had was a regulatory initiatives grid, which was an attempt to consolidate all the prevailing activities of the different regulators that affect firms. I think a new publication is due on that. But you would acknowledge that when you talk to firms, one of the biggest challenges is uncertainty. And they want to know what prescriptions they need to make in terms of investment to comply with regulations. How are you going to avoid a situation where you in this flux, as there's a consolidation to a smaller regulatory burden, that you don't create uncertainty, which has the opposite effect of stimulating more investment and economic activity?
We've published today the first phase of the output in our call for input on the Consumer Handbook, which we launched alongside our publication of the first report on the secondary competitiveness objective last year, and we received around 170 responses from a range of firms, trade bodies and consumer groups. And we've set out the areas there that we're going to prioritise in terms of simplifying the regulatory burden. You're quite right to point out that people talk to us about uncertainty and predictability, and the move to the consumer duty is a deliberately outcomes-based move. We are deliberately saying we want to move away from detailed prescription. We do think that's necessary for a technologically advancing industry such as financial services, because it's simply not possible for us to write regulation for every new advance that comes. AI, by the time we write regulation and make it effective, it'll be out of date. And therefore having the outcomes-based regulation of the consumer duty alongside our senior manager regime around for governance and accountability gives us, we think, a bit of an advantage actually over some of our competitor jurisdictions in terms of being able to enable innovation. I also think this requires a different dialogue with firms. We have said, for example, on the consumer duty, we're not going to go after every technical breach. What we want to see is reasonable endeavours to deliver these outcomes. We're working very closely with the Financial Ombudsman Service to make sure there's alignment there, because that's an issue that is raised in terms of consistency. We are publishing more good and poor practice case studies, as we did recently in our review of work on vulnerable consumers and on insurance markets as well, so firms can get a good sense of where we are coming from. And through that more elaborate dialogue with firms, we'd hope to tackle some of the concern you've just raised.
But my concern was, when we had the regulatory initiatives grid, which still exists, my experience of it was that every individual regulator would want to maintain their individual initiative because it sounded meaningful on its own. But the collective burden of everyone's meaningful individual initiative was, in aggregate, too much regulation. How are you going to reconcile what to drop and what to continue with? Because in truth, every part of financial services has a distinct oversight and regime in place. How do you see that process of arbitration? Will it be led by industry? And how do you reconcile that with the fact that if you go to more of that principle-based approach, you risk creating an ambiguity over what you're actually going to intervene on?
It was my turn this month to chair the Regulatory Initiatives Forum, which finalises the grid, and maybe I'll use chair's prerogative to spoil what we're about to announce in a couple of weeks' time. But what I think you'll see is a huge amount of coherence across the regulators, myself, Sam at the PRA, the Information Commissioner, the Pensions Regulator, and others. We come together. The government is present too. The government has been crystal clear about its strategic direction when it comes to regulation and growth, and it's important that we are all engaged and respond to that. We are going to pull back from some initiatives, some we've already told you about. So, for example, we're not moving forward with our data proposals on diversity and inclusion. Why is that? Because there are other regulators in the space, in particular government and parliament, that are legislating on gender action plans, that are legislating on ethnicity and disability pay gaps for the entire economy. So it doesn't make sense for us to do something bespoke in financial services. We have said we're only going to bring forward new regulation where we judge it to be really necessary. So, for example, some of the proposals we did have on our grid for this year around additional capital for investment firms, we're going to wait to see how some of the consumer duty is bedding in and some of our work on ongoing advice settles before we move forward with those. Likewise on data, we have moved forward with a number of data requests. We're going to allow those to bed in before moving forward with new ones, and we're going to rely on the consumer duty before coming forward with new rules on debt advice. Where you will see the number of initiatives go up is based on what we've announced this morning in terms of simplification. So they also count as initiatives. Even when you're reducing rules or simplifying rules, they come as a
Can I just give you one specific example? When I was involved in this, we changed. There was a consultative process with government around cards and increasing the limit for making card payments from, I think it was £30 to £100. There was some, I think the Prime Minister at the time, who was like, well, we don't need any limits at all. And the advice I received was that would be irresponsible because there was a consumer risk around that. I think one of the ideas that's been mooted is that we have no limits, that you can use card payment as, Apple Pay, there is no limit. But, just in a matter of 2 or 3 years, that concern around, people at financial risk for no limits seems to have gone. How do you see that issue now? And why is the sort of consensus around it changed? Is this really going to be a meaningful initiative for growth or just actually bring consumer harm?
We learn as we go, and I think when contactless payments were introduced, we didn't have the scale of adoption or the evidence on fraud, or indeed the level of take-up of digital wallets that we have today. We have published an engagement paper, and we're looking forward to all the feedback on that by May, which sets out the data very openly. There's actually lower levels of fraud on contactless payments than in other forms of payment. We've also looked at international experience. We're not talking about no limit at all. What happens in the United States, for example, is they leave the banks themselves to set the limit, and customers can also opt to set their own limit. Some banks in the UK do that already. There's a £100 limit that we set, but as a customer you can go on to your branch, or you can go onto your app and say, no, I want to cap my limit at £50 or £75, whatever suits your circumstances. And some of the thinking we have is that might support innovation, which because you allow a degree of variability and some innovation in the market. And the other thing, I'm personally not a huge fan of very hard-coded monetary limits in legislation, because it means we always have to review them every couple of years because of the economic circumstances changing, which is cost and time and effort in systems. And if we can think of a way of moving to a more flexible approach, that might future-proof payment models like that.
Thank you.
Thank you very much. Siobhan McDonald, MP.
Mr. Rathi, you've obviously read the memo and you've got God on growth. But could it mean that actually the FCA are involved in a bit of virtue signalling here? Because I understand that you recently scrapped the requirements to have a Consumer Duty Board champion on every board. It costs nothing, but it does concentrate the mind on boards to be for the consumer duty. So why do it?
I read every memo, including the Treasury Committee's memos.
You mustn't get much sleep.
With some detail. We always said that the Consumer Duty Board champion, the role was most important during the period of implementation of the Consumer Duty during the course of 2023 and 2024, so that we could get an additional layer of assurance that boards were taking this very seriously. Now, with the Consumer Duty fully in force, we felt that it was appropriate to give firms flexibility as to how they manage their governance. Boards remain responsible for delivery of the Consumer Duty. That doesn't change. Whether you have a dedicated board member who's a champion or whether you wish to arrange it in another way, we'll leave that to boards to decide. We have 42,000 financial services firms. Each has different governance and arrangements, and they have a degree of flexibility as to how they deliver it. We will be holding everyone to account against delivery of the duty, and we're seeing some good progress. And I'd be happy to talk you through how we're seeing that evolve.
But you save no money, you save no bureaucracy, but there is an opportunity for somebody on the board to have the responsibility to concentrate on the consumer duty. My late sister was the Consumer Duty Board person on Standard Life. And I have to tell you that she read every single document that went out to consumers because she accepted that as her responsibility, and she wanted to be sure that the company of which she was very proud did it properly. How does it help to abolish that?
So there's always this judgment about how prescriptive we should be. How prescriptive should we be about specific board champions, be it on the consumer duty or on whistleblowing or on other matters, versus, say, to a chair of board who has senior manager responsibilities and has to be approved as a senior manager, and of course the executives, that they have to make sure that the governance arrangements they put in place comply with all of our requirements. Some chairs said to us they would like the entire board to take the consumer duty seriously, and they have a different way of wanting to implement
But
the
you and I know
consumer
if
duty.
everybody's responsible, nobody's responsible.
The boards are responsible, and ultimately, of course, the chair of a board is responsible for making sure the governance delivers what's needed in terms of our regulation. And some firms may choose to retain a consumer duty board champion, others may choose not to. Bear in mind that we have some small firms who may only have a board of 2 people. So giving them a degree of flexibility may be seen as advantageous. And I think this debate around the level of prescription is something that's going to come up in all of our work on the consumer rule book. We have put out proposals today around whether we should be as prescriptive, for example, in disclosures around APRs, or whether we should allow a bit more flexibility in the market, whether we should be as prescriptive on mortgage disclosures. And I think I think that we couldn't make the argument that this was absolutely essential for delivery of the consumer duty. I can hear the force of your point, but giving people a bit of flexibility we think was the right step to take. Now it's embedded.
Thank you. Come on, Dame Siobhan's point. If there's somebody who's actually doing that due diligence on everything from a consumer perspective, so sitting in that consumer position, looking at it through that lens, that's very different. And we've all seen boards where, as Dame Siobhan says, everyone's responsible, but no one's responsible. And the ones that I've seen that have failed are often because someone thought someone else was really dealing with that, or they trusted the papers perhaps a bit too much, but didn't see the perspective. But you seem very confident that there is no risk to consumers, and yet you're, as a regulator, really there largely, a lot of your work is to be on the side of consumers.
We're doing a huge amount with respect to our objective on protecting consumers. The Consumer Duty Work Programme is very thorough. We have introduced new outcomes and data collection across a range of areas which we follow up on. And so we will always be holding industry's feet to the fire and specific firms' feet to the fire where we see issues. So, for example, we've seen the percentage of complaints on insurance and claims handling to the FOS go up by 18% in the last period. We have dedicated work going on in the industry on motor insurance claims, on home and travel claims, and we will be looking very closely at what's happening there. We spoke previously about life insurance claims at this committee. So that data-led approach will be how we will be supervising. We don't think that having one specific non-executive director on its own is going to be the solution to making sure the duty is successful and delivers what we need it to.
Okay, well, I think this is going to be an ongoing debate, especially with changes in regulation. Bobby Dean, MP.
I'd like to pick up on something you said in answer to Mr. John Glenn. You said that there's a huge amount of coherence across the regulators. In the Treasury's new approach policy paper, they sort of say the opposite. They said that regulation can be too complex and duplicative, and they talk about how each regulatory intervention might be rational on its own, but the cumulative effect is causing unintended consequences. They go as far as saying that they think they can cut administrative costs for business by 25% by the end of Parliament by tidying this sort of thing up. Do you think that's achievable for FCA regulated firms?
We'll have to see what the methodology is, and there's some work to do with the Treasury and the government more broadly on that, and how that is defined, how you account for benefits as well as costs. We're very focused on making sure we have proportionate regulation. And on your point around coherence, you obviously hear from us, you hear from the other bodies in the regulatory family like the PRA and how we work together, and we do work very closely together. A couple of weeks ago I wrote a joint letter with the Information Commissioner to all the financial services trade bodies, because some of the sprint work we'd been doing on artificial intelligence and data application, we were hearing feedback from the industry that they weren't sure how financial regulation and GDPR, data regulation, sat together. So we said, okay, bring us your problems, we'll have a round table in May, and between us we will fix those issues. We work incredibly closely with our partners on enforcement and financial crime as well. Does that mean we can't go further? Of course we can go further. We need to get data sharing in the right place. We need to get alignment on our strategic goals. So, for example, the government's economic crime plan is absolutely instrumental for us deciding how we coordinate and prioritise our resources, so we're all aligned.
But I guess going further and coordinating better sounds quite a bit of distance away from what the government thinks is achievable by regulatory reform. I mean, they even quote in their paper that they think that the impact of red tape could cost as high as 3 to 4% of GDP. I mean, they admit themselves in the footnotes that's based on figures from 20 years ago and fairly loose in other countries and so on. But do you accept that the growth potential of regulatory reform is as high as that it could be this kind of transformational thing for growth in this country?
I'm not here to talk about the government's figures. I'm sure you'll speak to the Treasury about that. What I would say is I think we as regulators, and the FCA is one of the largest, if not the largest economic regulator in the country, we acknowledge that how we regulate plays a role in the investment climate in the United Kingdom, and that we have a very strong story to tell in terms of our performance as a global financial centre. We remain the second largest, and we've in recent statistics closed the gap further. Around three-quarters of firms think we enhance the attractiveness of the United Kingdom. 97% of our practitioners said that they felt we were doing a good job on market integrity. At the same time, we get feedback that there's scope for us to be more proportionate, there's scope for us to be more pragmatic about some of the data requests, and there's scope for us to move faster on innovation. And I think addressing all of those openly, having this good risk discussion with you, will enable us to stay front of the pack.
Do you think that might be one of the issues that the government's having in understanding the value of the work you do, that it's possible to add up all the number of people you employ to work on regulation and attach a monetary figure to it, but it's much more difficult to discern the value for the benefits of regulation, the stability that you provide to the market and so on. I mean, can you talk to us a bit about how you define that in monetary terms, the benefits of the FCA's work?
Financial services in the UK economy represents £208 billion, around 10% of our GDP, around 71 billion of our trade surplus. But
specifically, how the regulator contributes to that, because
we're
all aware of how important it is to the economy, but how the regulator contributes.
The regulator contributes to that by delivering a regulatory framework which is aligned to high internationally consistent standards, where there's trust and consistency in our approach, which makes it attractive for firms from all over the world to come and locate here in our jurisdiction. And we play a thought leadership role in those standards, and we are world class, I would say, and Ashley can speak to this given his international experience in how we implement our work. Very often we find that the work we do is looked at very closely by some of our closest international partners. Mr. Glenn touched on that in some of his experience, and I think that's an important part of our reputation, and that sustains the ability for that part of our economy to be the most significant part of our economy when it comes to our trade surplus.
So I think I accept that, but I guess that's qualitative feedback, and you're up against these figures that the government's quoting about, £70 billion worth of red tape costs. Do you find one of the difficulties in making the case for regulation is that you can't have those hard figures to back, because it's kind of counterfactual, really? How much money have you saved the economy by providing the stability and everything that you've described?
So we have a whole range of metrics that we publish and measure, some of which we control, some of which we contribute to. We published the first set of competitiveness metrics alongside our first competitiveness report last year. We've set out in our strategy today further metrics that we will publish. All of this is a rounded judgment, and we present all of this to you here in this committee for you to help you make a rounded judgment. There's no one figure that answers all of these things. I do think that the fact that the export levels of UK financial services has continued to grow is a positive for our economy. The number of jobs has gone up. We're also seeing improvements, by the way, and we'll publish this in our Financial Life Survey, on inclusion. The number of people without bank accounts in the UK has gone down in the last 2 years. More people are accessing some core financial services. That's also, and always will be, very important to the ethos of the FCA as well. So we want to bring all of this together and deliver on all fronts.
John Glenn, MP.
Yeah, one of the things that you've done under your leadership is initiate and lead a transformation programme for the FCA. I mean, I think we'd all appreciate that the transformation programme is trying to transform an organisation of nearly 5,000 people, and you have said in the past that governments over time have added more and more into the FCA. Could you update the committee on how your transformation programme has progressed and what effect you think that will have on improving the interface with the firms that you regulate?
And Mr. Glenn, you'll be familiar with this, and as the Minister who was in post as I was appointed and embarked on the programme, and I was always very appreciative of the cover and support you gave when public sector reform isn't easy, and it takes time and it's hard, and we're under a lot of scrutiny. I would say, first of all, I'm immensely proud of my colleagues. We've put through a huge amount of reform over the last 4.5 years, some of it difficult, some of it challenging, and my colleagues, 5,000 colleagues now in London, Leeds and Edinburgh, have stuck with us. We have our lowest turnover rate, voluntary turnover rate, other than during the year of the pandemic. We have very high retention rates of colleagues now who have 8 or more years' experience. We're an organisation that's genuinely national now, with 10% of our colleagues in Leeds and Edinburgh. We have a stronger operational platform. We have moved to the cloud. We're using data and intelligence in a much more sophisticated way, which enables us to go after harm faster. So, for example, we have now, in the last year, intervened 20,000 times to require misleading or problematic financial promotions to be amended or withdrawn. 2 years ago, that was 570. That shows the industrial scale with which we're able to use technology now to go after harm much quicker. We have introduced higher standards, consumer duty being the most notable, which provides a really firm springboard for the future. And I hope this committee has seen over the years that we've also sought to respond to feedback you've given us about seeking to be more open, including where things don't always go right, and so we can learn the lessons, but also have a debate with you about how we're prioritising resources and risk as well. So I think all of that sets us in a really good place to deliver the 5-year strategy we published today.
Mr. Glenn.
Could you, though, I mean, we acknowledge that, well, I acknowledge that progress, but in terms of what's outstanding, one of the things that I think firms would probably say is that the interface with the FCA can sometimes be quite sort of clunky, and the iterative process is not as smooth or as quick as necessary. And when you're an entrepreneur with burning through risk capital, you want that to be quicker. Can you say something about how you see the progress to date? And obviously you won't want to expose what you haven't done, but tell us about, for the committee's benefit, how the interface with companies that you regulate is going to get better, hopefully.
Sure, I was going to turn to Sheree on authorisations.
Yeah, that would be helpful,
but
sorry, it's just been about you.
One thing we've published today, which is bold, is we're going to move away from having 43 portfolio letters in each sector for chief executives to 7 simplified market reports, and we are looking to only retain by exception the thicket of Dear CEO and other supervisory publications that predate 2022 to make it simpler. Sheree may want to talk about the work on authorisation, and Ashley might want to pick up.
Thank you
as well.
Well, just the point I was going to make was just from a board perspective. The challenge to the executive team over the last few months when it comes to our interface with the industry has essentially been around, yes, we have a strong platform, in fact a world-leading platform when it comes to our approach to consumers, and of course that's configured around consumer duty. We're leaning into consumer duty a great deal. And Nikhil mentioned earlier on the publication today around our feedback, the feedback on the call for input on the question of outcomes versus prescription. And again, Nikhil sorted out. But basically the challenge was this. The reflection to me and others from industry is kind of threefold. One is around what I call kind of the velocity of policy. I.e. the volume of policy making coming out of our organisation and others in aggregate, and I think you mentioned that earlier on. So that's number one, and I think it's a real issue, and the question then is to be rigorous around prioritisation, and the challenge is to do that without letting go of the standards that we've achieved for industry and for consumers and within wholesale markets. The second Nikhil's touched on, which is the supervisory interface. When I first arrived in this role just over 2 years ago, that was one of 2 points that was raised with me by industry. The other was authorisations, which Sheree will touch on. And the third element, again, which we've discussed with the executive in some depth, and Nikhil has touched on, is the volume of data requests. As Nikhil said, we need data without any doubt whatsoever. But the question then is, what is the level and detail of data we need to address the risks which we are concerned with? And that's a genuine question. So in those 3 areas, we are certainly, that's the challenge to the executive team from the board, and the executive team has picked that up with alacrity over the last few months as part of the overall strategic positioning, which as you know, were published today, but maybe I should go over to Sheree.
So obviously, Ashley has mentioned the fact that a core focus was on backlogs, and Nikhil mentioned earlier that over 99% of our applications in the last quarter, so the last full quarter, which is obviously Q4 of 2024, were determined within the statutory timeline. In terms of our openness and being more transparent around that, we've also now published quarterly statistics which demonstrate the median, the lower quartile, the median, and the upper quartile number of days. And that's calendar days, including weekends and bank holidays, and ignoring the stop clock, and all of those other things that apply in legislation to get applications determined. So that's part of our, for example, if we talk about the senior managers regime, the median is about 40 days versus which is less than half, just over, less than half of the actual statutory timeline for the median. And the upper quartile is something around 60 days. But that's about speed, but it doesn't answer your question around that clunky interaction, and we're very focused on that. And I've spent a long time meeting a range of firms and trade bodies, etc., and listening to that feedback. And we are taking some of that forward. A key part of that is digitising our forms. That progress is underway. It's not a straightforward and easy process, and it will take us time to do it. But the feedback we've got on the very first form we've digitised 3 now, but the very first one, which is our most prevalent, is the senior managers form. So get approval for a senior manager is very positive in terms of it's much easier to use. Everything's in one place. We've cut down the additional paper that people have to append to the application. So that has been positively received. We are now working our way through. We're on new firm applications now, along with some of the payment services forms. So from that perspective, that will improve focus, and we will see less backwards and forwards, because as we're digitising the form, we're being thoughtful about what we need and making sure that we get everything we need. That is also enabling us to implement greater validation right at the front end, so that we can be certain that the data is accurate from that perspective, but also will in time enable us to have alerts and things off the digitised data, so that if firms tell us they're going to grow in this way, we will be able to have alerts when they've been authorised to sort of say, well, actually, they're growing faster than that or less than that, and should we be examining why that is, and having a conversation so it will help our supervisory colleagues down the line. So I think there's many advantages, and as I say, feedback's been positive, but we're early days.
When we think about financial services, broadly the UK is very competitive out in if you look across Europe, but we always cite it as the US as the place where things are faster growth and so on. Do you have perspective through the international networks that you operate in, how we're doing in terms of best practice globally in this regard? Because obviously many of the firms that you regulate operate in multiple jurisdictions. How do they see your progress against what they can see as best practice in the rest of the world?
So I would say, obviously, everyone's recognised the fact that we are now much more speedy. That doesn't necessarily mean we are best practice. We are working and seeking feedback from firms on how we can improve. It's a continuous journey. We have got a whole plan of things that we want to do. One of the things that we've committed to in the PM letter is increase the preponderance of minded to approve, minded to authorise, because feedback we have received has been quite strong around the fact that we want to dot all the I's and cross all the T's before we
want to give a signal earlier to that. Signal earlier, which will then give investors confidence to keep funding in the firm. And that's been a feedback we've received from firms who, whether that happens internationally, but has been a very strong feedback on I would have kept going had. Thank you very much.
On that point around international, we do our practitioner panel survey, and we're surveying tens of thousands of firms this year, and we'll of course share that in our annual report with the committee. We tend to get strong feedback on how we contribute to the UK as an international financial centre, and the depth of expertise that exists at the FCA, which many would say is amongst the best in the world, if not in some areas the best in the world. We of course have to keep working on our operational performance. But one rider I would give to all of this, and this is where we do need the support of the committee, where you may get feedback that something is a clunky interaction and that case officers are being difficult, they've got a job to do. And sometimes their job involves asking pokey, difficult questions that those who perhaps are not willing to comply with the rules are not that keen to answer. And I'm conscious, Mr. Glenn, you wrote a piece about crypto, and you urged us to be more open-minded, and we are not anti-innovation. We absolutely want to make sure the UK is an attractive place. But let me be really clear with this committee. 86% of those applications were refused because they did not meet the standards that you have given us to deliver in legislation on money laundering. And we held back approvals of some of the largest firms in the world, which did get approvals and licensed to operate in other very large jurisdictions. We got a lot of flack from that, including from some of your former colleagues, but we had a job to do. And some of those things went badly wrong elsewhere, and we didn't allow that to happen here in the UK.
I think the point I was making was that, as you've acknowledged in this session so far, the world is changing, the competitive environment is changing, and therefore it's incumbent upon the regulator to ensure that the UK as a jurisdiction brings clarity on what the regulatory regime is, because by having that, that is important in terms of investor confidence, which I think you acknowledge.
Absolutely.
I think just one very quick point is one of the overriding sort of objectives and purposes of the strategy that we are publishing today is to signal very, very clearly what the FCA is about. Because I think that in years past, there's been, and I've seen this from a different standpoint internationally, the FCA has been regarded by its peers as being best in class for all sorts of reasons, internationally. Domestically, I think there's been a high level of confusion over what its core purpose is. And we are, the strategy that we're publishing today, one of the objectives, as I say, is to land on that purpose.
But
very clearly.
I mean, the government has, first we've had governments of different colours leaning into the secondary objective on growth. Do you not think, Mr. Alder, you've come in more recently to this as chair, that's quite confusing? Even with your, you can put it all, you can put it into a document and strategise it, but you are being pulled like the push me pull you in different directions, aren't you?
Yeah, and actually, I think I read your I think op-ed in the FT, and I think landed on this exact point, which is there a kind of either-or problem here to do with our core objectives, including the consumer objective and growth? What we are looking at from a practical perspective, and from a as a regulator, what we are positioning our strategy to do is absolutely lean into growth for good reason. You may have seen that Andrew Bailey made a speech yesterday where he was commenting around growth, but he's also commenting around the demographic challenge we have. Yeah. We do have a situation where with pension freedoms, people have choices to make. How do we lean into those choices to give as much help as possible? That's AGBR and similar. Yeah. All of these interlocking aspects of our strategy basically go to absolutely a preservation of standards, which from a consumer perspective is mainly around consumer duty, but at the same time recognising that there needs to be a shift in the balance of risk in the system and an explicit acknowledgement of that to then lean into growth.
But do you think that the productivity gap is a result of poor regulation? Because all of these things, even in aggregate, will they really drive growth?
I think I just lean onto one, or mention as one aspect of what we're doing, which is broadly around investment in capital markets. So I think it's been there's been lots of commentary about over some time now about the degree to which pension funds invest in UK enterprise effectively, and the degree to which the population as a whole have the tools available to them or don't have the tools available to in order to participate. Contrast that with the United States and other jurisdictions. There is, I think it's very difficult at this stage to put numbers on this, but to the extent that we have significantly changed the rules around the ability of businesses to get into the shop window, in other words, listing rules down the track, PICEs, which we can come on to, long-term asset funds, etc. We have changed those rules, or some are in the process of being changed. That is significant because that does allow businesses to get into the shop window. The trick really here, or the objective, is to provide, effectively to encourage pension schemes or pension to prioritise returns or long-term returns over cost, and alongside that, put the tools that are valuable to individuals who do have choices to make, particularly given
well,
demographic
we're going to come on to,
growth.
because I think we're going on to some of that when we talk about
that,
advice.
but I think that those projects and those reforms which are intersecting is a large part of the story around the relationship between regulation and growth.
You talked earlier about the velocity of policy, so that's Parliament, government have to take their part of that as well. But we're now seeing the velocity of change. Different regulators. We'll come on to some of the ones you've got connections with in a moment. We had one of the new members of the PRC in front of us the other week who was saying, changing things can also create burdens for businesses. Actually retracting regulation. Isn't there a danger that we're just throwing a lot of chaos into the mix, despite the demands of many businesses to reduce regulation?
Yeah. So,
just a very quick one on this one. So that's why. So last summer we put the call for input out on. We're moving to an outcomes-based approach. To what degree does that mean that we can dispense of rules that exist on in our handbook? And it's a fair question for the industry to ask and for us to raise in that context, because ostensibly that goes to regulatory burden fundamentally, and what we basically got back in response from industry, we got a lot of feedback. It was really useful. Is that firstly, broadly there was simplification was welcome, and you may have seen that the European Union is going down the same path. Which is with a program that they call their competitiveness compass. It's very, very similar sort of rhetoric around that. So welcome simplification, but, and I think that was touched on earlier, there is caution around a rapid shift to high-level rules. And there is a degree of anxiety around interpretation, judgment, how specific rules should be or should not be around a shift in outcomes-based approach. There was a degree of concern in that context from a consumer protection perspective, and also in particular small firms who may feel that they're not necessarily equipped to make such a shift, a quick shift. And on top of that, implementation costs. I mean, quite clearly, if you're looking at a significant change where firms have baked into their systems the current rule book, there is an implementation cost around change, which is why right now the organisation is taking a more sort of targeted approach to how it will approach the rule book. And I won't repeat what Nikhil said earlier on, but he went through a few of the issues on that. So this is for us, this must be an evolving story, an evolving project.
And we'll try to be as creative as possible here, because we have conflicting feedback from firms.
You really are pulled and pushed.
And the Prime Minister asked us to deliver this year in his letter that he sent to us on Christmas Eve. So there's obviously a desire for urgency. And we replied in early January, so we had a busy Christmas. We've said today we're not having a widespread overhaul of rules. And one of the things I've said publicly, to go to your point, Chair, is maybe one way through this is to have long transition periods when we do change the rules. So those firms that are ready to move quickly can move, but those firms, maybe smaller firms that just need the time to pace their change, they're given the time and space to do that. That carries a cost.
It was interesting when we might get onto the issue when there were the problems with bank payments, and Barclays was obviously at the centre of it recently. And we had several of the outages we wrote to them about. The information we got back from banks was often in quite different formats, so it's quite interesting to us to see how people provide data, how organisations provide data. We could go on about this forever, but I think we need to move on to other matters. So I'm going to bring in Chris Coughlin, MP.
Mr. Robbie, you said in the autumn that private markets, well, you asked whether there'd be a risk or an opportunity in your speech. What opportunities do you see, and to what extent do private markets just represent regulatory arbitrage rather than innovation?
We want to see businesses being able to access capital from a range of sources, be that public markets or private markets in the form they would like, equity, debt, or other forms. We have a leading global private markets industry here in the United Kingdom that manages these assets, not just for investment in the United Kingdom, but also globally as well. We have a significant growth in non-bank actors, hedge funds, private equity, family offices, sovereign wealth funds. And to a point that Ashley made earlier, this is one area where we need data. As the scale of these activities increases, we want to make sure we're understanding what is going on. And I don't want to make a call early that this is somehow some very significant systemic risk. But we want to understand what is going on, in particular where significant leverage is being taken, and what the interconnections are between, for example, hedge funds who take on significant leverage and banks and other parts of the financial system, so that we are alert to risks, but manage those in a proportionate way. And we've also published a review in the last couple of weeks on valuation practices. Public markets are transparent. You can see the prices at the end of every day. There's a benchmark for valuation. Private markets, by definition, don't have that infrastructure. And one of the things we were keen to understand is, what are the processes when people are valuing these assets with respect to investors? We saw some good practices, but we've also called out some areas where we would like to see improvements in the way conflicts of interest are managed, in the way that independence of valuations are undertaken, and in some of the formality around ad hoc valuation processes when there are significant disruptions in value. So that vigilance is also an important part of the work we do. And I co-chair one of the groups of security markets globally that's also very vigilant on these issues.
So it sounds like, to me, regulatory arbitrage is a significant risk. I mean, of course, the opportunity of this vast growing market is hugely attractive to the UK, but obviously when Lehman collapsed, one of the biggest issues was no one knew who the counterparties were, which you've done a vast amount of work ever since in the public market space, but surely there's quite a significant risk of repeating the same mistake in the growth in private credit here.
So I believe on the latest statistics, around 15% of our outstanding corporate debt in the UK is debt from private companies, companies that employ around 2 million people here in the UK. And you're right, what's important for us is to have the data. And I don't think we're in the same position as we were in 2008. You know, the way in which we collect data, we have centralised trade repositories, we have central clearing in many markets, we have direct powers to access data as well. We're reforming some of the reporting requirements, for example, for hedge funds and in other areas. But it's not just our data that matters. One of the really critical issues that we're working on globally, and indeed my colleague Sarah Pritchard, our Executive Director for International, she co-chaired a group globally around non-bank data. And there are significant improvements that are needed around the world because we need to have that cross-border sharing of data precisely to avoid the point you make around... It's not necessarily regulatory arbitrage within the United Kingdom.
For sure.
It can be regulatory arbitrage
anywhere,
cross-border to go to the jurisdiction where you have to give least report.
Yeah, and I mean, specifically on Pisces, how does that fit into this? I mean, given the FT reported that I think multiple venture capital and private equity investors said they are unlikely to use it. How do you think there's going to be enough demand for Pisces, and isn't it a bit of a contradiction in terms?
We don't know, but we also don't make policy based on one FT report. Obviously, although I'd say that we did look at your op-ed very carefully, Chair. So that FT report was particularly influential in our organisation. We can't stand still. We know there is an issue with the way in which private companies are willing to access capital here in the United Kingdom, and not all find the move immediately to a public market environment appealing. Founders want to hold on to their shares. Employees may want to trade those shares. Some of their institutional investors may want to trade those shares too. And the government's leading the way on this because they have to legislate, and they'll legislate so we can take this forward through a sandbox. We're going to try something new. And we're going to try so that a broader range of investors can access these potential opportunities. There's going to have to be an adjustment to some of our market abuse rules because it's not in the public environment. There'll be intermittent trading. There'll be potential for discretion around price bands, and we're going to limit it in the first instance to certain sophisticated investors and high net worth investors and employees. Some say, as you say, they don't want to use it. They don't have to use it. Others say they do want to use it. And we'll see.
Sure. I mean, I guess someone who used to work in public markets, I'm just sort of trying to understand how you'd have the market make a demand for this kind of thing to work, and how you were essentially just creating another form of public market. So then why wouldn't a PE fund just want to go and do a normal over-the-counter transaction?
This is going to be intermittent trading. It's not going to be continuous trading during open market hours. And the potential frequency of that intermittent trading is something to be determined. And so what we do here is, for example, employees who could be employed, have shares in a private company, but then have no way of realising those shares, may find it useful at certain points in the cycle, after results have been produced or other points, to be able to have a mechanism to realise those shares. And you might have strategic investors who may want to take advantage of that opportunity to buy in. As I say, it's early days. We'll see if it works.
And I think it might be in the FT who characterise a insider trading risk for this. So, how do you mitigate that? And is that an unfair characterisation?
I think Pisces is a really good example of what we were touching on earlier, which is trade-offs around and risk rebalance. Because although those, at least the first phase, who are able to invest and participate are going to be restricted to high net worth and sophisticated under our definitions, nevertheless, that's a significant section of the public. And they will be interacting with small firms, by definition, outside the normal regulatory regime when it comes to things like insider dealing and market abuse. That's how it has been set up. So that risk trade-off there is, firstly, go in, its eyes open. It leans it more into caveat emptor. Yeah. There's a emphasis on the operator of a platform to manage risks within the platform, but they will not be managed in the same sense as a fully regulated, normal public market. And that is quite deliberate because, as Nikhil said earlier on, some objectives here all around one issue that has kind of bedeviled growth for businesses, which is that start-up to scale-up.
Yeah.
And scale-up is fundamentally about transitioning to a broader investor base. I know the FT article said that some of those investors may not be interested, but as Nikhil said, put it out there.
Yeah.
Don't not do it because some may not agree or may have different commercial objectives. But just be eyes open that there is a higher risk that companies that take advantage of this are not going to be under the same set of regulation. It is different. And some may fail or investor losses may occur. But that is, I think, a very good example of the trade-offs we were talking about earlier.
Great.
Baldwin MP.
Thank you very much, Chair. And further to Mr. John Glenn's questions about the rolling in of the payment systems regulator into the FCA, can I just ask Mr. Alder if this was something that the FCA board proactively offered up to the Treasury as a way in which things could be simplified on the regulatory front?
No, we didn't. No, we didn't offer it up as a project for the government to take on, as it were. However, one thing that we did do, which is effectively part of the journey, and it was, as I say, it was not to do with a specific proposal to fold in the PSR, was around, I think it was around the time that the National Payments Vision was published. There was a decision to create a new ED post, which was ED for payments and digital finance. And that person would also, there's an interim role, you saw David not long ago, there's a person who would then also be the managing director of the PSR. So I think that, in a sense, although we didn't make there wasn't an ask, it set the direction of travel. And I would say around the PSR, as Nikhil mentioned, the payment system is enormously different to the one that we that existed, was it 13 years ago, I think thereabouts, when the PSR was created. I'll just say one word, which is stablecoins. One piece of work, both with us and the bank, is to do with stablecoins and the regulatory framework around that. One use case for stable coins is payments. The other thing we're doing within the FCA is we look at payments firms as distinct from payment systems. So I think the direction of travel around integration and efficiency and policy consistency around all of that was correct.
The payment systems regulator, from the point of view of this committee, certainly speaking personally, had rolled out automated push payment reimbursement since last October, something that many of our constituents benefit from. Forgive me if I'm a bit sceptical, but I am really sceptical that that would have happened if payment system regulation had been under the umbrella of the FCA for the last few years.
Yeah, it's difficult to comment on the counterfactual, but I, frankly, given the sort of policy focus on fraud, and in particular on APP, financial crime controls within firms, which is the fundamental focus, I don't believe, sitting where I am now, that there would necessarily have been a different outcome.
Okay. Well, as you say, it is a counterfactual, and we can hold different views on that. I just wondered, in terms of the decision, when you heard about it, Mr. Alder, was it the same day as we heard that David Gill heard about it and the chair of the payment systems regulator heard about it? In other words, the day before it was publicly announced.
Yeah, we heard from, in contact with or in interactions with the Treasury, I think it's around late January, we heard that plans were kind of in progress around the PSR, but what those plans would result in was not particularly clear. I think around late February, we were told that it was probable that an announcement would be made around the PSR. But sometime in March, but again, nothing specific. And the day we learnt that there would be an announcement and a change was, I think it was 11th of March, which was the day before it was announced.
Okay, thank you.
You got the calls. You got the calls in February. You got information before they got the call the day before on the 12th of March, on the 11th of March.
Yeah, well, 11th of March was the day in which was the day that we were told an announcement would be made. Anything prior to that were discussions around the payment system, around PSR in general, but there was no.
Who did you get a phone call? Was it? How were you informed?
I didn't personally.
No. Nikhil?
I think the discussions around the PSR have been out there for some time.
We know that. I mean, certainly there's been some in the ether.
National
There's a difference between there being an ether and you as the body taking them over.
So I think the Treasury's thinking was going in this direction. We were hearing it from Treasury officials as
who was called? Did you get a phone call the day before, or how were you informed?
I think that I didn't personally get a phone call. I think one of my team did, and I think the PSR did.
It's just that you've been in and out of number 11 and Downing Street as one, but the PSR wasn't in that position. They hadn't had any contact since their letter.
I did speak to the Economic Secretary the day before the announcement, particularly once I'd already learnt about it, and particularly around the handling of the announcement, because one thing that was very important for us at the FCA is to make sure that our colleagues at the PSR can feel pride in everything they've achieved. And Dame Harriet talked about APP fraud and other things, and we wanted to make sure that was handled appropriately.
Thank you. Dame Harriet.
Yeah, just if I may, Chair, Mr. Rathi, have you, in your operational decisions now in terms of integrating the PSR into your organisation, have you scored any savings in any budget projections?
Not yet, because the PSR will continue with an independent board until legislation is passed, which I believe.
And what have you heard on the legislation?
Which I believe the target date for the government, subject to parliamentary scrutiny, is by end of 2026.
By the end of next year?
By the end of next year. That's for legislation to go through.
And the legislation will transfer all the powers that PSR has to you?
I think that the Treasury has said that the powers will be broadly folded into the FCA, but they're going to engage with stakeholders on that discussion, so that any other views can be fed into their final decision making, and then they'll put that before Parliament in the legislation.
So you could potentially have absorbed the organisation without having got the powers across then?
Well, the formal ending of the PSR board will only come when legislation is adopted. Right. But what we are doing, and what we were already doing as Ashley described, is we want it to be integrated, we want it to be coherent on open finance. On APP fraud, I hope you are reassured by what we've put in the strategy today, because we've explicitly called out the importance of tackling fraud and financial crime, including APP fraud. Over the last strategy, we have seen progress on investment fraud. It's been hard, it's been tough, but we've seen the numbers come down as well, and we've got a record number of financial crime prosecutions. So I hope we can assure you that on fraud, the FCA corporately is very focused, and we are leaning in
and then the
hard.
Important piece of work that they're also doing on the high credit card fees that some of our constituents suffer from. Can you reassure this committee that that's not going to slow down as a result of this organisational change?
The PSR work programme continues, and I think David gave you that reassurance when he was before the committee. I think that was in the letter from the Treasury to this committee around the work programme. That work continues. There are highly expert colleagues in the PSR, and they're getting on with the job.
Thank you, Chair.
We spoke to the PSR. We've struggled to find what benefits there would be to businesses. In the end, it's the board will go, so there'll be one board, quicker decisions, more streamlined approach. But you're taking on all the staff, pretty much. You already have the payroll benefits and so on. So where will the savings be, both in money terms and for the will there be any reduction in stickiness for businesses that are going through you on these issues?
Mr. Glenn raised the point earlier around supervisory coherence, around the number of interfaces that firms have with different regulators. But they'll have
interfaces with different people in the FCA. They'll still have to go through separate teams, surely. If it's going to keep its work programme, as you just said.
Absolutely, but some of the work programme we can do jointly. So, for example, the work programme on open finance, what the payments remit letter, which was issued to us jointly by the Chancellor last year, said, asked us both to lead in open finance. You'll have one organisation leading on open finance, working together. Same on Dame Harriet's point on APP fraud as well. So we could hopefully ensure there's a good streamlined interface across all of our work. My view on all of these things, I think, has been consistent, which is, as I say, the architecture is a matter for the government. Every single objective the FCA has to deliver, and every single priority we have set out in our strategy this morning requires us to work in deep partnership with other regulators and other authorities in the system. And that's why I've been very focused on making sure we've got the data sharing in place, we have secondments, we share expertise and resource. We are probably one of the most connected regulatory bodies in the country. And that's how we have to work.
Okay. Well, I think we're going to be looking at this in future quite a lot, and even if it's inside the FCA's umbrella, absorbed into the FCA, I think the work of the PSR will be something this committee will focus on. Thank you very much. You and Yankee.
Thank you. I've got some more questions about cash savings, and in particular the cash ISA, following the speculation in the FT, sadly to refer to it, the FT again, about lowering the 20,000 cap on the cash ISA and also switching to cash and equities ISAs. I was wondering if the FCA has done any impact assessment on the different groups this would impact if this change were made.
No, we haven't.
And in our last session on the lifetime ISA, one of our panellists, Anne Fairweather, told us that the FCA is due to publish research on consumer saving and investment behaviour. I was wondering if that has been done already, or what the timeline is for that. What are the questions?
May I write to you on that
Sure.
in detail? We've published a whole range of research on consumer savings and investment behaviour, particularly on savings rates, but also on the use of technology, and we're producing our financial life survey later this year as well. But I can fill you in on the full work programme by correspondence afterwards.
Is the reason that you haven't yet done an impact assessment of the potential cash ISA changes that you don't see them as live proposals, or is there another reason?
Well, the tax changes are a matter for the Treasury. So unless we're told formally that something's happening and we're being asked to do some work, these are matters for the Treasury to decide on. I think the ministers have spoken about this publicly, and I know there's further opportunities for Treasury Ministers to explain what they're doing here.
I mean, based on the research that you've done in the past on consumer behaviour, and also Mr. Alder, your comments previously about investment culture in the UK and the lack of retail investment culture compared to, say, Hong Kong and other areas. What would you see as the impact of changing the cash ISA arrangements in terms of moving different consumers into different forms of investment or not?
I'm reluctant to express a view on that cash ISA question because, as I say, tax matters are a matter for the Treasury. The broader point around whether we're getting the optimal outcome in the UK with the amount of money that's being held in cash, be that in no interest bearing current accounts, easy access accounts, or cash ISAs, I think is a very relevant point that we are surfacing in our strategy as well. And a key piece of work we've been leading there is the advice guidance boundary review, because we clearly have a system in the UK where people are not feeling confident to get the advice that they need when they need it at a price they're willing to pay, and that perhaps is making them cautious about moving out of cash into different types of assets, which might generate better returns for them over the long term. And we're hoping that piece of work, which is accelerating, will help provide one foundation in the market as well to help people make some of these choices. And
my colleague Ms. Blake will go on to discuss the advice guidance boundary. But before that, is your overall view that so long as consumers are given the appropriate guidance and advice and access to good advice, and that will shift investment behaviour over the long run? Or do you also see that there are groups of low income or risk averse consumers who will forever be risk averse in their behaviour, and that is not shiftable? How shiftable do you think the overall culture is?
I think this is going to take decades, but I don't think that one aspect of our work on its own will shift this. We spoke last time I was here about a report the Education Select Committee did in the last Parliament about financial education and financial literacy in the UK. It's quite a seminal report. It may be an issue this committee wants to lend its weight to, because we have issues which are quite serious that start in schools but carry on all the way through the workplace in terms of basic understanding of things like percentages, compound interest, and other choices that people have before you get into even a discussion about taking more risk with your hard-earned savings. We then have to make sure that we have the right accessibility to those products at the right point in people's lives, including looking at how we can improve digital journeys so people feel confident about accessing those products. So I would say it's a range of things, and then ultimately there's also the question about confidence in the economy and growth, and that you're going to get the returns.
If you were to take every single consumer in the UK, which of course you don't have personal insight into their minds, but do you think all those different groups across income spectrums, across different demographics, could be shifted to more risk-taking behaviour in their investments with better education, with better advice, better guidance and so on? Or do you think that only applies to one proportion of the consumer range in the UK?
It clearly doesn't make sense for every single consumer. There are a significant portion of vulnerable consumers who don't even have £1,000 of cash to deal with an unexpected life event. And we have to make sure we have a savings intervention, including discussions with the Financial Inclusion Committee as to how that situation can be improved. And there's some really interesting interventions that employers have been leading on workplace savings, payroll savings. Even £10 a month over a few years can change people's resilience.
Yeah.
There'll be consumers who will be saving for their first home, again, who may not be in a position necessarily to pursue market investments. But we also have millions of people who we believe have in excess of £10,000 in cash who perhaps don't need to be holding that much in cash and might get better long-term security by taking a longer horizon. And we want to make sure that mass market is served too. So we need something that works for everybody, from the most vulnerable to those who have more assets available but are not making best use of them at the moment.
Yeah. So you're really looking at consumers perhaps in their late 30s, 40s who've bought their first home. They're relatively well off in terms of income to have those savings. Is that the kind of demographic that you're looking at shifting, or can you paint a picture of who we're thinking
I think
about?
age may be one component of it, but there may be other people, of a different age range who can take advantage of these opportunities too, both older and younger. It's really, and everyone's life circumstances may be different as well. So I'm reluctant to give you too focused a cohort analysis. Really, it's making sure. What we also know, for example, on pension saving, is that some of the biggest benefits to pension saving can come from the age starting that saving when you're under 30, because you get the benefits of 30 years of return. So it applies to that group too, but the amounts you're going to save at that age are obviously going to be somewhat lower, because your earnings are typically lower than you would be if you're further up the journey. One thing I also think is not great is the sheer number of under 35-year-olds for whom the financial product that they invest in first is crypto. Several million in the UK, rather than equities or debt or other types of products. Now, that's something that we want to engage in as well, because we know there's a very high risk and you could potentially lose all your money.
Thank you, Mr. Rathi.
Thank you very much. Lona McAvoy, MP.
Thank you, Chair. So, in the country, I think the majority of people in all of our constituencies have got the message that we have an issue with stagnating growth. You said, Mr. Alder, that there's an issue on pension fund investments in this country, and you said, Mr. Rathi, that there's an issue with firms going public and an issue with investment for those firms. We all know there's an issue with the prevalence of cash saving in the country. So is the issue that you and your organisation have neglected the secondary objective of growth? Is that the real issue? Because when we're building all these things together, what we're seeing is that there's a pattern on big problems with the pathway to growth, and is it a failure of the organisation on the secondary objective?
Well, the secondary objective arrived in 2023. So
Yeah.
I think we've embraced the objective since it's been enforced, and obviously we had a different set of objectives prior to 2023, and I think Dame Siobhan said to me earlier, I think coming at this from a different angle, that she felt we got the memo on growth and competitiveness. So I think we are embracing the second objective wholeheartedly. We've put 50 proposals to the Prime Minister, but what we're talking about is a mix of tax, education, regulation, broader culture in our country. So, for example, in the United States, 38% of households will hold direct equities. You have double-digit 20% or so in Sweden. In the UK, it's significantly lower. That's not all on the FCA. There is a much broader societal discussion that we need to have here, and we also have evolved a particular approach to risk and compensation in the UK, which perhaps isn't matched in other jurisdictions around the world as well. So we're part of the move to shift, but we are part of a system, and it requires us all to move if we're aligned.
Okay, so we said that the committee said that we've got a world-leading consumer protection regime. So why is consumer confidence in investment as a way to make better returns so low? With your own Financial Lives survey that you mentioned earlier, saying 4 million people have got in excess of this £10,000 in cash savings. So why, if we've got such a good consumer protection regime, why is that not translating into people taking more risk with their own savings, do you think?
As I say, part of it, I think, is cultural in the UK. Part of it's also that our advice system has not been as effective as it needs to be, and that's something that we need to change. And I think part of it is also we've been through a tumultuous economic period over the last 8 or 9 years, and let's not shy away from the fact that investing in markets can be quite hair-raising at times. Even since the start of the year, we've seen enormous volatility in some of the largest stock markets in the world, in the US and elsewhere. And so it requires a degree of considerable patience and resilience to weather those storms if you are a retail investor who perhaps isn't familiar with markets. So all that plays into people's caution too. We shouldn't step away. We shouldn't also ignore the fact that there have been interventions in the UK that have really shifted the dial. So, for example, the move to auto-enrolment has dramatically improved the state of pension provision here relative to where it was before. Now, we all know that we're not done, and there's further to go, and the demands that people have in terms of living standards and what they need to for retirement continue to intensify. But we are in a much better place than a number of other jurisdictions on that issue in particular.
So just to go back to you brought up the pension auto-enrolment. So obviously that's great. We know there's a pension, we've got a bit of a ticking time bomb coming down the line with the lack of certainly self-employed people and the lack of pension support that they've got. If our pension funds aren't investing in UK companies, or there's this problem, what can the FCA do to sort of, how are we going to work, how's the FCA going to help solve that problem?
We're working really closely with the DWP, Treasury, the pensions regulator. One significant piece of work is around our framework for value for money. And one of the pieces of feedback we've received is that there's been too much focus on cost rather than the holistic view around long-term returns that people can get. So we are moving to adjust that. The Chancellor at the Mansion House event last year talked about the need to consolidate some of our pension funds to give them the scale and expertise to be able to invest in a broader range of assets. Some of those pooled local authority funds will be regulated by us. Our early work on the advice guidance boundary review is particularly looking at advice around decumulation decisions that individuals take with respect to pensions. We have instituted, under Mr. Glenn's leadership in fact, the introduction of long-term asset funds to enable DC pension funds to invest in a wider range of liquid assets without daily trading, and we've seen, I think, several billion now and a number of funds approved by us. The specific issue around investing in the UK, that's a policy question, I would say, for government and Parliament to make the call on, and it links into tax. That's something we would take direction on. It's not something we on our own can take the lead on.
So just the final one for me, in the interest of time. You've mentioned a few times there are certain things that require legislation, and you would take your leadership from government. What other things do you think the government should be looking at and considering in terms of legislation changes to enable the growth mission to succeed?
In my letter to the Prime Minister, they did ask us to give any ideas, and so I don't know whether...
Go on, what's the burning idea that you want us to take?
We had to be careful in what we suggested. But I mentioned a few things. I think that when we look at innovation around the world, one area where we have fallen behind is the speed with which identity is verified, both for individuals and for corporates. We used to be a global leader in open banking and open finance. Other countries like India, Brazil, and the Middle East, they've moved ahead of us. And I don't demur at all from the fact that these are very vexing political issues. There are civil liberties questions. I just make the point that we can see that we are falling behind. And to Dame Meg's point earlier around what could contribute to growth and productivity improvements in the UK, I would suggest getting that fixed would contribute, and not just for financial services, for access to health services, for access to e-commerce, for access to other parts of the economy as well. You see that happening in other countries, and we're somewhat slow. We've talked about the improvements that could follow in Companies House. We've talked about speeding up the court system and digitalisation of the court system, because one of the things that holds us back in terms of the speed of our cases is it can take a number of years to get through the courts. And then the other more technical piece of legislation, we publish a perimeter report which we send to the TSC every year with our recommendations for legislation as well. And in fact, I had my first meeting with the new Economic Secretary on the perimeter yesterday afternoon, but she will publish the minutes of that meeting, not me, when they're ready.
Thank you.
Food for thought. Rachel Bacon.
Thank you, Chair. You've been trailing the advice guidance boundary review all morning, so I'm pleased that we get a chance to dive in. And we have painted a really complicated picture about how consumers are responding to the current financial products available. Only 57% of defined contribution pensioners are reading some of their statement, which I found really worrying to read. I was relieved that I'm in that group, but that does mean that 43% are not. 22% of people don't have confidence that they have a plan and feel unprepared, and only 9% of people are taking up regulated guidance. At the start of this session, you said that the advice and guidance boundary review could be transformative. Can you put some figures to that?
Not yet,
Okay.
I'm afraid, because we're still finalising it, and some of it will be down to legislation. But we do believe that moving away in a calibrated and careful way from customised, personalised advice and enabling advice and guidance to be given to cohorts of customers, people like you might find it suitable to invest in products like this. So targeted support, which can be provided by firms in a much more cost-effective way and in a digital way, could catalyse products for the mass market in a way that's not possible at the moment. The risk conversation, to bring it back to that I do think is important to have with this committee, is that means it's not going to be perfect for everybody.
Mm-hmm.
So we may see significant benefits for the mass market, but for a minority of consumers, you might get a suboptimal outcome or a worse outcome to the one they get today. And that's exactly the type of conversation we need to be having with you and with the government to make sure we're all on the same page as we move forward.
So you haven't got a sense of scale. We've got an understanding of how many people are not fully prepared, but have you got a sense of scale of how much this situation could be holding us back, or the potential for the benefits of growth for this review?
Well, clearly the numbers we have, and you quoted the 9% figure of adults taking regulated financial advice now. We will be publishing our 2024 survey shortly. That figure hasn't moved. And clearly that's deeply unsatisfactory.
Yeah.
I haven't got a figure for you yet. We haven't finalised the review, and the legislation is not determined either as to what we want to take that to. But you'd obviously want over a number of years that number to be substantially higher.
And will that number,
9%.
and will some of those metrics be in the next stages of the review?
We publish. One of the things we want to have is lots of outcome metrics that we can be held to account on, but also recognise that we're one contributor to those metrics. We're not the only organisation that contributes. So yes, we will be publishing that metric every couple of years, so we can track progress.
That metric of take-up. Are there any other? It seems to me there could be other metrics and modelling in terms of what the impact of advice is.
There's metrics around the number of people taking regulated financial advice. There's metrics around the point at which you seek your advice on decumulation. At the moment, people tend not to engage with their pension until after the age of 50, which in many cases is just far too late. It's very hard to change course, so we have some data around the number of people who engage at the age of 40, 45, and trying to bring that earlier on. We publish data around the number of people who have investable assets over £100,000 who take financial advice. We've already talked about the number of people who have cash over £10,000. We talked about the amount of cash in the system. So all of those are metrics that we will look to publish on a regular basis and track and help give you a rounded view as to how we're progressing.
Just a quick question. One idea that's out there is about auto-enrolment to advice appointments. Have you got a position on that? Have you got any research on that?
We did some work on pensions nudge and other things previously. Ultimately, these are matters for DWP, and I know Dame Angela Eagle, when she was on this committee, was very focused on this topic. One of the challenges we saw is that not everybody liked being told they had to turn up to an appointment, and you had quite a lot of non-response or when you did the pilots. And so there's the question of who is the right body to stimulate people to take advice. It could be an auto-enrolment with the Money and Pension Service. It could be your employer. Very often we find that the engagement from employers is much more interactive than from a government body or from a state body. And we've seen that, for example, on workplace savings, where when your employer has offered you the savings of £10 out of your payroll, the take-up has been much higher than non-employer-based schemes. So I think this is a system-wide effort, government, regulators, businesses, to try to get this engagement.
If there was more research that you mentioned about the impact and some of the measures around auto-enrolment, I'm sure this committee would be very pleased to read them. I just wanted to come back to the process and the timing, if that's okay, Chair. So our understanding is that in the first half of this year, the FCA plan to consult on the detailed requirements with draft rules and guidance around retail investment and pensions, and then there's a cost-benefit analysis, then there's a policy statement, and then there are some final rules. Is that correct?
Yeah, so we'll consult in the first half of this year, and we will follow all the processes around CBA and rulemaking that are in the legislation.
Yeah, so would you say it's the legislation that's determining the timescale of this? Because for something that could be transformative, notwithstanding we don't know quite how transformative, that could, by my calculations, that could be at least 2 years.
We want to go as fast as possible, but we also have to respect the processes in legislation around CBA panel, around how we consult, and also one aspect of this involves the Treasury proposing legislation to Parliament, and the timetable for that is within their gift, and that necessarily there is a huge pipeline of legislation, not just on financial services. So the ability to get a slot, I think, is a matter for them. But we're going as fast as we can, working very closely with the Treasury. But these things do take time, and it also takes time, as we talked about regulatory initiatives earlier. It also takes time for firms to implement and change their systems.
Okay, I think that's about 2 years.
John Grady, please.
Thank you very much, Dave Meg. People rely on this sector more than ever, and so trust in this sector is critical. Maybe a question for Mr. Alder, but obviously we've got the review we've just been discussing. If you look at the investment universe, things like crypto, do you think much more is needed beyond that review to secure good advice and outcomes for consumers?
In relation to crypto specifically?
Crypto and just more generally. And I'm mindful of time, so we should keep the responses short.
Well, I think that question just goes to, I think, the direction of travel, which is, it's quite a course correction, actually. And that's sort of encapsulated in our strategy around putting the right tools in the hands of consumers to enable them to interact. We use the phrase risk-taking or rebalance of risk. That's interacting with financial products with the overlay of consumer duty and the consumer duty expectations of firms to enable them to interact with the services and the products that then contribute to their longer-term financial well-being. And I mentioned earlier on the demographic challenge around that, which again Andrew Bailey has also raised, and this question of giving people, and not forcing, but giving people the tools necessary to enable them to engage with the right products for them in that context. Now, if you want, I could comment on crypto if you would like.
Brief comment, please.
Brief comment. Yeah. Well, I think fundamentally, briefly, it falls into three buckets, the whole crypto universe, one of which is stable coins, which is, and we are looking at fiat-backed stable coins. One is so-called unbacked crypto, which are sort of the crypto assets which you're familiar with. The decision has been taken, I think, internationally and in the UK, that we will move forward with a framework around that, and we issued a roadmap not very long ago, which set out the steps we would take around this. But fundamentally, it's a comprehensive framework around things like custody, the way in which crypto exchanges operate, etc. The third element is actually the technology itself, which are kind of what some people call the rails of distributed ledger, and that the applications of that could be numerous. I think it's still relatively early days, but that's why we've set up the digital sandbox, for example, in relation to that, and also pursuing projects such as fund tokenization. And that's basically how the technology can be incorporated into effectively traditional or existing financial services. That's the piece. We have said, Nikhil said this before, that in relation to crypto, unbacked crypto assets, be prepared to lose all your money.
Now that illustrates an interesting point, because you're looking at regulating this further. So maybe a question for Ms. Howard, and again, nice short answers please, because time's marching on. But do you think the consumers understand the precise role of the FCA? So just because a business is authorised by the FC, for example, do you think a consumer understands that you're not endorsing it as selling suitable products? Do you think what do you think a consumer's understanding is of that?
I think we do a lot of work to drive that understanding. From that perspective, obviously, we've invested heavily, for example, in the Financial Services Register to drive, as one place that consumers can check. to see whether the product is authorised and regulated or not. You know, we've been very clear, I think, if we talk about crypto, very clear in all our messaging out that, you know, be prepared to lose all your money. I think we have been consistently clear for many years that that is the case. I think at the moment we only regulate crypto for AML. That's very clear publicly. But I think, you know, when you go into social media and things like that and it's out there, it's very tempting for people to purchase it. But I think we've been really clear.
Now, if I'm sitting in Shettleston on a Friday night, I don't go looking at FCA registered,
I agree with that.
I?
Yes, understood that. I understand that. It's probably not the first thing on your list.
And, or the last for that. But not only on a Sunday morning. But if I see on a website that a firm is authorised by the FCA, would you agree with me that it does not follow that the FCA endorses that what that firm sells is a great product? And would you also agree with me that it does not follow that everything that that firm does is regulated by the FCA at all?
That is correct. What it does mean is that for where we have authorised it and given it permissions, we are comfortable it meets high standards to get through our gateway.
The fact that I've got the FCA label on my website does not mean, does it, but the FCA is supervising that firm intensively.
It's a risk-based approach to we operate a risk-based approach to everything.
Yes. So the FCA may not be
perspective.
supervising that firm in any great detail at all.
Well, we get a huge amount of intelligence and data and information, and that would trigger activity around that firm as it would, and that market, depending on
But
on
it
what
follows,
is.
just from the point of view of a consumer in Shettleston, it follows that proportionality and risk-based approach, it must follow that some firms are monitored very intensively and some firms not at all, or to a limited extent.
I wouldn't say not at all, but yes.
Limited extent. And it also follows, because the FCA is full of human beings, that judgment sometimes may, in retrospect, turn out to be less than ideal. And some firms that weren't supervised intensively could have, in retrospect, have done with a bit more intense supervision. And it also follows that the FCA isn't guaranteeing that any firm is well run. Against all that background, how clear do you think the consumer's understanding of this regime is, and the extent to which they can put trust in this regime?
On crypto in particular?
No, just more generally. Just an investor saving for their pension or their grandkids in Shettleston.
So I think, I suppose I would answer that in various ways, but in brevity of time. We're very clear, and I think it is clear that you know, if a firm has been through an authorisations process for certain permissions, it meets a certain level of standards, and we're quite clear on that. We also have very conscious of what you're terming is really the halo effects around. Is there elements of their business that is not regulated that might be less, but we are, you know, through the gateway we take a much more holistic view of the firm to make sure that we're comfortable that the firm as a whole is operating well. But equally we would be very clear that if people invest in unregulated activity, that carries higher risk than investing in regulated activity.
And have you got any data on consumer understanding of what all this means?
Not to hand, but we can come back to you. But I
very,
think
very
we did, for example, I mean, I know I mentioned the Breakfast Register, and I know you said you wouldn't be checking it on a Friday night, but we did do extensive research, for example, with consumers around their engagement with it and understanding that system, which is why we're going through a process of transforming it, because the feedback was not that consumers particularly understood what was there.
Well, that's a good news. Now, just turning quickly to compensation, I don't want to get into the detail of these cases, but in the collateral case, the FCA has said that it could have done better in simple terms. For safe hands, there's no compensation whatsoever. this low level of compensation for collateral and no compensation for safe hands, is that damaging for consumer confidence in the savings and financial services market, Mr. Alder?
Well, I think you need to look at these case by case, and clearly there's been a lot of publicity around this.
Mm-hmm.
I think in just generally speaking, let's look at safe hands, for example. Safe hands, in relation to that, the issue, the primary issue for us, for the organisation, was to bring an unregulated sector into regulation through the gateway, in fairly short order, in fact. And that was in 2022.
Now,
what we
sorry, Mr. Alder, I don't want to interrupt, but I think we might come back to safe hands.
Oh.
But and we've read the correspondence, which is very helpful. The question I'm getting at is more, if you look at this from a point of view of not an FT reader, but someone like me sitting in Shettleston on a Friday night reading the Daily Record, I'm asking myself, am I confident in this sector? Am I not confident in this sector? This low-level lack of compensation overall, is that damaging to confidence in the sector, by contrast to the fact that I know that if I go to the Bank of Scotland in Shettleston, I'm guaranteed up to £85,000. It's really that I'm getting at. It's the overall, if you like, impression of confidence and safety for investors.
Yeah, well, look, I think the system is not straightforward. Let's be clear. And the system might, in practice, be difficult to explain to someone in your position on a Sunday morning. It might, and that's the truth in practice. And the compensation system itself, which to a degree is under review, when it comes to the intersection between, for example, the Financial Ombudsman Service, which is the place where consumers can bring complaints, through to failed firms, which of course is FSCS. That is also a compensation system which is actually quite broad, particularly when it comes to FSCS compensation around failed firms and advice, for example. We have a compensation system which also involves redress schemes, very prominent at the moment. And then we have a particular difficulty, frankly, around expectations of the FCA when it comes to firms that are actually unregulated. So to give you one example, a sector that could come into regulation, and there's a direction that's the direction of travel, is buy now, pay later. Now, currently that is not regulated, and there are concerns that have been raised around that. The question for us right now is, should we devote our resources to an unregulated sector? Because there is a level of expectation in some quarters that we should, and there's a question as to whether we should or not. So I'm kind of describing, it's not, frankly, I don't think it's not a neat answer to your question. Really,
no,
frankly, because the compensation system is complex, our perimeter is complex, and that's the environment in which we operate, which I fully understand is not plain to the average consumer.
And final question from me on this chapter before we move on to other things. We've got the motor finance case, for the collateral case, safe hands, potential of issues with BNPL. That's in a lower risk environment. As we go on this dash for growth, would more of these cases fall within a tolerable or acceptable level of harm or failure from the FCA's perspective?
That's the discussion we'd like to have with you. I think there are different components there. Motor finance is a systemic redress situation, where what is being looked at is whether there was compliance with the law that was in place and the rules that were in place before 2021. And some of that's our rules, some of that's statute, Consumer Credit Act, some of it is common law. We'll see what the Supreme Court has to say. I've said publicly at a speech I did to the ABI that beyond motor finance, we're not envisaging any other systemic redress events based on the complaints data we're seeing. It's a question you asked me last time, Dame Meg. On the other issues, I think there is always a choice around how quickly government and parliament want to bring new things into the regulatory perimeter. Funeral plans, I believe Mr Glenn as Minister got the first report in 2017. It didn't make it into our perimeter until 2022. Buy now, pay later. A report was done in 2021. Perhaps in 2026 it will make it into our perimeter. Those are choices that government and parliament make. And I think one of the things we have said in terms of metrics is we do need some acknowledgement that those are political choices, and we can't carry responsibility for the 10 million people that are using buy now, pay later at the moment because you have not asked us to devote our resources to it, and there's been a debate around it. Then on the point around risky investments, yes, there will need to be, if people move into riskier investments, be that equities or infrastructure or scale-up companies, not everything is going to work out. What we hope, though, is for the critical mass of consumers, over the long term, they will get better long-term returns and better and more secure retirements, but we can't guarantee that for 100% of the population.
Thank you, Dame Meg.
Thank you. The Complaints Commissioner recently upheld a complaint against the FCA about the way that it handled the failure of Safe Hands, the funeral plan company. Specifically, the Commissioner says that the FCA did not act on a tip-off about Safe Hands in 2021. I appreciate that your response is that you get lots of tip-offs and you can't investigate all of them. But this wasn't the first bit of information you'd had about Safe Hands. You'd had numerous complaints about them in the past, and you, as is so often the case when a scandal happened, you were also aware of some of the people involved in Safe Hands, in that you had concerns about the owner, Richard Wells, and as you were investigating some of his other companies since 2018, you had concerns about the fund managers, TGAM Partnership, and had them under investigation since 2019. So you knew about these people, you knew their pattern of action. Was it that the people who had pension plans were just poorer and didn't matter that much?
Not at all. I'll turn to Sheree, but the important point to note is we did not allow Safe Hands into the regulatory perimeter. They were refused authorisation. They went into administration. Sheree can explain in more detail.
Yeah, certainly. First of all, obviously, I'd like to acknowledge that lots of people did lose their funeral plan money for their prepaid funeral plans when we didn't allow them into the regulatory perimeter. And you are right that there have been extensive work on Safe Hands. Historically, we're talking several years before, in the years between 14 and 16.
So the complaint in 2021 wasn't the first time you'd heard about them?
No, but we had no reason, but we have worked with them extensively between 14 and 16 and have got, got ourselves comfortable. They were in an exempt regime, exempt from the Regulated Activities Order under 61, from that perspective, and we got ourselves comfortable with operating that way. They were brought to the attention of HMT and ourselves, as were several firms, in a report in 2017, but nothing which led to us believing that they were breaching the exemption at that point. It is absolutely the case that as we were working to bring this regime into the perimeter at speed, as Nikhil has said, we were working at pace because the legislation was laid in 21 and they all had to be authorised by July 22. We had to lay policy, deem them, and we were gathering information on the sector as we were going. We did receive one piece of anonymous intelligence which could have led us to act. The gateway was about to be opened. I appreciate a few months later. I do appreciate there was a little bit of a gap. It was at end of April 21 and the gateway was opening in September 21. That activity was looked at and logged because the view was that we would act far better and far faster through the authorisations gateway. Through the authorisations gateway, we get far more information. It's what has to be given to us in order for when they apply, because we have standards that they have to meet and we have to look at it. So they gave us far more information. We could ask quite extensive information through that. It landed at the end of October. And in early February, we were having minded to refuse conversation with the firm because we had identified serious concerns. I can't go into those because there is a wider SFO investigation still underway, but we did identify concerns. We had that conversation with the firm. It withdrew its application very quickly after that conversation, and then went into administration. We then did work actively with other providers to provide discounted funerals for those providers, but it was not in the regulatory perimeter. We made a judgment. On that one piece of anonymous intelligence, a judgment was made that it was far better to be dealt with through the authorisations gateway, where we can
one
gain
piece of
information.
Anonymous information and lots of concerns about the people involved and previous complaints. If in the FCA's response to the complaints, Commissioner, you've disagreed with her findings and are not taking any further action. What's the point of having an independent complaints commissioner if regulators can simply brush aside their findings?
So, my first response to that is we view the independent complaints commissioner as a very strong accountability mechanism. So, and we view complaints as a mechanism to learn, and that's a really great way for us to continuously improve. We do respect the Commissioner has a different view on the action that we could or should have taken on that one piece of anonymous intelligence, but equally admits that there is no say as to whether that would have reached an earlier conclusion or a different conclusion, or would have meant that the firm failed earlier or later.
If the findings of the Commissioner don't matter, perhaps they should be another target for abolition.
I didn't say that. I said we respect and we revere the independence of the Complaints Commissioner very strongly. We just have a difference of opinion on what may have happened had we tried to act on that piece of information. There's no saying that the firm would have responded to us immediately. They gave us a lot of information through the gateway.
But they are then toothless, aren't they?
I wouldn't say that. We've done a huge amount of work on the back of that.
Have you had a disagreement with the Complaints Commissioner?
I can't remember exactly the
percentage.
It's very high, roughly.
The vast majority of the
vast majority we accept.
Accepted, I think there's
that's what I say.
Vast
majority,
over 90%.
Something like that.
But I think, and we have the utmost sympathy with the people who've lost out here, and obviously, we talked about the time it took for this to get into the perimeter, and it's because this is of interest to parliamentarians that we proactively wrote to the committee to explain our position, and the Commissioner herself says she couldn't say with any certainty if we had acted on one piece of anonymous intelligence that had already been sent to the Funeral Planning Authority would have led to a different outcome. We have to prioritise resources. On buy now, pay later, and Ashley's touched on this, we can read it in the media today. There are allegations of very serious potential misconduct out there in terms of debt collection and other things. At the moment, the Government and Parliament have not decided to bring this into our perimeter. So we have to make a judgment that it's not appropriate for us, nor do we have the powers to go in there and chase down every piece of intelligence that we're getting about that kind of misconduct. At the point that it comes in 2026, at the Authorisations gateway, I'm almost certain that there are some firms that will not make it through that you can read about in the press today where there are problems. But we're not going after that. And we have to make a judgment around when we have 34,000 pieces of intelligence. You have to make a broad judgment about the quality of that intelligence and how you prioritise resources. In our strategy today, we've been really clear about this, and it's quite important that we do land this point with you, that when it comes to tackling financial crime, there's a huge waterfront. 39% of all reported crime in the country is economic crime. We are going to focus our resources on the crime that gets reported to us that might have links to the regulated perimeter. Criminals within the perimeter. That necessarily means there'll be cases which we are not pursuing, and we're not able to pursue, because we just don't have the scale of resources to do that.
Can I just come out? You mentioned buy now, pay later. This is an issue that's rumbled on for several years. There is a real consumer detriment in some cases, but it's also quite complicated to work out how you work out if somebody's got multiple buy now, pay later contracts in place, in essence. So there are consequences for regulation. We've been talking about growth and streamlining, and how do we reconcile, the consumer interest with that growth imperative? On this buy now, pay later one, from my understanding is that it's complicated to deliver a regulatory regime that will deal with the consumer harm and not chill the therapeutic value of a new product. Would you evaluate that trade-off before ministers would make a decision typically on whether to proceed?
We've been interacting very intensively with the Treasury all the way through their multiple consultations on this, and because it's been such a delicate issue, they've had several rounds of consultation to try to get the calibration right. And there are some judgments in here which are entirely going to be matters of judgment for Parliament about what the threshold is that you set in terms of where you want regulation to kick in, and are there some thresholds below which you don't want regulation to kick in, and that's that choice between accessibility to a product that is convenient to people. The average use of buy now, pay later is £69. It's very different to credit cards and other forms of credit. We think the consumer duty helps us even further because it gives a framework for information requirements. There are some bits of the Consumer Credit Act which should be disapplied because they just don't work for this type of new product. And we are going to have a debate. We will be ready to consult as quickly as we can once the legislation is laid around affordability and creditworthiness checks. How far do we go?
But the truth is you can't protect everyone by regulatory intervention, can you?
No. And I don't think Parliament asks us to. At all. I think you ask us to you've given us a range of objectives, and you've talked earlier about the secondary competence objective as well. You ask us about innovation, and you've asked us about growth. So I don't think, and I think one of the principles in FSMA is that consumers must take primary responsibility for their decisions, and that's in the law.
Can I just pick up on the point, Dame, before I go back to Dame Siobhan? The individual in the case of Safe Hands was known, there was information about individuals involved, as well as this other bit of information. When you get tip-offs, and obviously you had a lot, we understand from your letter the arguments you've made, do you have a matching up process? That there's how do you have red flags presumably that arise?
And one of the things.
So was there no match between what the anonymous tip-off and the other red flags you already had about suitability of individuals?
But I think I should explain that the judgment was made that this was now coming into the perimeter.
Yeah.
And,
so that was the main.
I'm just an enormous number of powers.
That was your main reason
and
for
the way
delay.
so there was no, and I don't think the Commissioner has said. I think that she doesn't know whether an earlier intervention would have made any difference, and we'll see what comes out of the Serious Fraud Office.
On that early intervention again, before I go back to Dame Siobhan, with the collateral situation, there was a 2-month gap between you asking the company to cease trading after you discovered the fraud. Do you have any analysis when you have these situations? These are 2 examples. There are plenty of others. We get letters about these sort of things all the time. Do you have any analysis about how many people will lose out if you have a delay? Sometimes in the case of Safe Hands, obviously there wasn't much money there anyway. I mean, it was unlikely people were going to get reimbursement because the company went bust. But do you look at that when you're in your decision making? Are you thinking, if we take this length of time, there's a further risk to more consumers? Do you weigh that up as how?
So in short, yes. I mean, I think one of the reasons that we have accepted that we took too long, there was a balance because that work was going on at the time. I wasn't party to that, but there was a balance going on as to is the firm seeking really to come in with collateral? It had applied to come into the perimeter. Was it really seeking to regularise its position? How do we protect consumer money? How do we make sure that we do it in the right way? There was a 2-month gap. When we look back at it with an independent cold head, yes, we decided that perhaps that was too long and we should have acted faster to get them to stop, which is why we've apologised and accepted the fact that we could have done something differently there and better.
Thank you. Dame Siobhan, did you want to come back?
I just have a personal concern about the breadth of your work and the expanding area of your work and your involvement of kind of quite vulnerable people with not very much money. And they were, in something you said, you referred to them as investors. For this group of people, they didn't think they were investing in anything. They thought they were getting an insurance policy to prevent their families from being responsible for their burials and to prevent them from that very shameful thing of having a pauper's funeral. So they were acting with the highest levels of responsibility and respectability. So in a way, from my perspective, they would need even greater need for your care and consideration?
I mean, this weighs on us a lot. I mean, in January I spent some time in Bournemouth, in a debt advice centre where I met addicts who had got into quite serious debt, small amounts actually, originally starting £100, £200, but then that led to a cycle which was incredibly challenging for them. So we absolutely recognise that. We produced a review on vulnerability just a few weeks ago in light of our work on consumer duty, where we've particularly put a limb of the consumer duty to focus on vulnerable consumers in terms of information they receive, markers that firms have. We've called out good practice, but we have called out areas where we think firms could go further in terms of product and service design and metrics. We don't decide, though, which products are in the perimeter. And I understand what you're saying, that people thought they were buying. This was something that was being discussed and considered by the Treasury and then subsequently Parliament between 2017 through to 2022. That's the same for buy now, pay later as well. And we have to be respectful of using our resources on things that Parliament has asked us to do. We have made the case on buy now, pay later, but we also have to respect the fact that it's not our decision, either the substance or the timing of when that comes into regulation. That's a decision for this House.
I'm struck in the conversation, we're talking about some of these events happening in 2021, 2022, but recently we've had the news that the FCA plans to automatically delete its emails after a year. And we know it's not a sort of data storage issue because data storage is pretty cheap. And I think FCA is on the record as saying it's to reduce legal and reputational risk. Can you explain that decision a bit better for us? Because it would seem to some that this could present a huge risk to FOI requests or maybe even inquiries by this committee.
Absolutely. We've also put out a blog report for everybody to see. So it's important to be clear what we are and we are not doing. So this won't apply to any emails that exist before the 1st of April 2025. So it will only apply to emails after that. So the first round of deletion on the 1st of April 2026. It won't apply to any shared mailboxes through which decisions are typically made. So all the board decisions and the range of governance decisions we have, and also for the most senior people in the organisation who are holding the most decision-relevant information. It won't apply there either. We also have statutory responsibilities under FSMA to hold records, and we'll comply with all of those statutory responsibilities. Holding 70 million emails, though, is not good records management practice. We've invested very heavily in data repositories so that we can get data, to the point actually just earlier around how do we get the data in the right place so we can act on it. We've now got very good cloud-based infrastructure, and we want colleagues to be using that effectively and not holding on to emails that are no longer needed. Also for GDPR reasons, and I believe the ICO, Information Commissioner, has a similar 12-month policy on their website. We shouldn't be holding on to information for longer than we need to. Therefore, we think this is a proportionate way forward. It will require a shift in culture because we know we need to improve records management, and that is something that there's intense focus and effort on, but we think it will make us a more effective regulator over time.
Yeah, I guess the concern, though, is, and I admit there's going to be plenty of emails that don't need to be kept for a long time, but who gets to judge which emails need to be kept? And we've talked earlier on today about the potential increased risk to consumer harm that's coming down the track, but at the same time we're kind of shutting down an element of transparency. So what confidence can you give to consumers that the email deletion policy is going to be robust and will keep the consumers' interests at heart?
So we're not changing the definition of what is a record that needs to be kept at the FCA. I mean, those are there. There's some legislation around that as well. So we are, that isn't changing. And as I say, the decision-relevant records will need to be maintained, and that's a large number of the shared mailboxes. And as I say, the most senior people in the organisation are most engaged in those decisions. And we will, of course, be tracking operationally as the policy is implemented, as other organisations have done, I think, that have implemented similar things, how we're progressing. We want to see our shared repositories used effectively, because we know from some of the cases that you just talked about is that when things happen afterwards, actually trying to trawl thousands, if not tens of thousands of mailboxes is quite problematic. And actually, if you want to use AI and data analytics and some of these techniques, you need to use state-of-the-art records management to be able to deliver. And that does require a shift from tens of millions of emails into our systems, which will enable us to be more effective.
Okay, thanks. I'm going to move on to another ongoing.
So before you move on, I just want to say, have you benchmarked on this data retention? I know that in one government department saw information from the archives, and about half of them were out of office replies because of the way the archive was. So it's not just the FCA that's having this problem. Have you benchmarked this 1 year approach?
Organisations, either public or private, in terms of their experience. I think the information. Yes, we have looked. The Information Commissioner's position in terms of their own organisations on their website, and there's been some reporting that somehow.
With them,
other similar regulators, other governmental bodies, and there's been some discussion that somehow we're doing something that we wouldn't tolerate firms doing. We do not expect banks or insurance companies or others to hold every single email of every single member of staff all around the country indefinitely. We expect them to hold the relevant information in the systems that they choose, the records knowledge management systems they choose, so that they can track decisions. That's certainly not the case that every single email of every financial services employee is held forever.
A job opportunity, maybe a growth opportunity for records management companies and individuals, so that we can go back to
data is a very strong growth
for the country.
Sector for the country.
Thank you. Mr. Dean.
Yeah, thank you. I'm going to move on actually to motor finance. You made an announcement recently about a potential consumer redress scheme being introduced depending on the Supreme Court result. Can you tell us more about why you think that approach might be appropriate and what it will look like?
We have maintained ever since we started looking at because of the volume of complaints that were being raised around discretionary commission arrangements, we've been clear that part of the reason for looking at this was to understand what had happened, whether providers, be that brokers or lenders, have been failing to follow our rules, and if so, had consumers lost out as a result? And if they have, what is the best way of delivering recompense or redress to them in a way that is orderly, consistent and efficient? So that has been our mantra right since the beginning of 2024. Obviously, we were working on discretionary commission arrangements. The Court of Appeal judgment landed. That has potentially expanded, depending on where the Supreme Court lands, to cover wider commission arrangements in the motor finance world. What we're saying is our work is still ongoing. We are still gathering evidence, and I can't talk about numbers or anything like that because it's still too early to say, and a lot of it will depend on where the Supreme Court lands. But a lot in this, we've talked earlier around, business and investor confidence is driven by predictability and clarity. We thought it right to, and we, if you look at our messaging over time, Nikhil had previously said it was more likely that we would intervene than not, as we were working through. And what we're now saying is that a consumer redress scheme may be appropriate, but we haven't said definitely.
I appreciate you can't say too much, but if I can try and add on some specifics. If the Supreme Court judgment goes the way that people expect it might, around widening the number of cases that were taken into account, so the wider commission arrangements, will your scheme include wider commission arrangements? Will the scheme be mandatory? And how quickly do you expect the scheme to get up and running after the decision?
So if we do decide to do an industry-wide redress scheme, that will be open to public consultation. So there will be a ability for this committee as key stakeholders, but parliamentarians, consumer groups, firms, to participate in what that shape of that scheme should look like. We will obviously, if we decide to go that way, we'll put proposals forward. We are still working on what that might look like, and a lot depends on where the Supreme Court will land. But from our perspective, it will be open to consultation, so we can't possibly, a key part of the parameters is open to that, as will the CBA, cost-benefit analysis approach.
Obviously doing some complementary work now, though, and I know that you've been engaging with firms. It's been reported to me that you haven't been engaging with some of the consumer law firms that are involved in bringing forward these proceedings. They're saying that actually the consultation will be very focused on what the firms want to do and not necessarily what the outcomes are. So could you confirm whether you've engaged with any consumer law firms on this as well?
So we've engaged with consumer groups, and we have a round table with consumer groups later this week, actually on Friday.
But not consumer law firms then. So
I don't know which law firms you're particularly talking about.
Well, I can name a
go
couple
back
if you refer. There's Sentinel and then there's Cormax. I know they represent thousands of clients, and they're saying that they feel a bit shut out of the consultative process so far. Would you engage with the consumer law firms?
So we haven't started any consultative process, so that's critical from the perspective of this committee's understanding. Okay. We have said if, depending on where the Supreme Court goes, and we deem that there's been a widespread consumer redress mechanism, then we may consult on an industry redress scheme. At that point, we will have a full consultation with all bodies. We are, of course, consulting with firms through this process, understanding how they're preparing, because, of course, from their perspective, when on the 4th of December, when the complaints pause ends, they've got to start handling complaints again unless there's been some other interaction. So we've got to make sure that they're still working behind the scenes. And we know that certain firms are working very closely with those legal firms, but I can't go into any more detail with this.
I think the reason I asked that question is because the situation is not straightforward. It's not just a straightforward case of commissions are there or not. There's been all sorts of allegations around volume bonuses, advanced commission payments, and other kind of complex incentives. And obviously these law firms have been quite close to that, and the firms have obviously been quite clever in writing their contracts. So do you have any fears that just a consumer redress scheme without the involvement of legal firms and claims management companies might result in undercompensation for consumers?
If I come in there, we have thresholds to meet before we introduce a redress scheme, and of course one key threshold is compliance with the law, and the Supreme Court will give the final determination on what the law is, and a number of those issues that you have raised may be taken up by the Supreme Court. We will have to wait and see. And it's our job to assess any redress scheme against all of our objectives: consumer protection, market integrity, and competition in the interest of consumers. And one of the reasons we're signalling now that we would be likely to consult is precisely so everyone can get ready, including, I would suggest, this committee, because I imagine you're going to be very interested in this topic as to how you may wish to engage with such consultation when it comes. And when it comes to our consumer protection objective, we absolutely would want to make sure that if there has been unlawful activity, that there's appropriate remedy for that. Touching on some of the topics we talked about earlier, we also need to make sure that this market works well in the future. This is a market of 2 million consumers every year and worth around 40 billion of finance every year, 1.4 million used cars, 600,000 new cars. So we have to also make sure that whatever we do also ensures market works for consumers in the future, as well as something proportionate for anything that might have gone wrong in the past. And that will all be subject to debate and consultation from all parties. The law firms you mentioned, consumer groups, firms, parliamentarians, the government. It's a topic which captures a lot of people's interest, and we want to be able to do this as openly as we can when the time comes, if the time comes.
We're going almost 2.5 hours now, and we could probably go for another hour on this, so I'm going to hand back to the chair.
In future, how to look at the expanding work of the FCA. For sure. Ms McAvoy.
So, in the interest of time, I'm going to keep a quick question. Can you tell the committee what's really going on with the name and shame policy position?
We call it enforcement transparency. We wrote to the committee. I think Dame Meg will be familiar with this because one of the parts of context that prompted us to propose this in the first place was a Public Accounts Committee report in July 2002, where the Public Accounts Committee asked us to look at being more transparent around firms that are under investigation. I've engaged this committee, including under Dame Harriet's chairmanship, and we said at the time, when there was obviously a response to the initial consultation, and I've written to the committee about things we could have done differently, that we'd want to secure as broad a consensus as we could. We want to secure as much confidence as we can on something like this. There is broad support for some aspects of what we were doing, particularly confirming investigations that are already in the public domain, for unregulated, unauthorised activity, and also sharing details anonymously of issues of concern. So we will move forward with those. We won't move forward with the proposals in relation to introducing a public interest test for announcing investigations into regulated firms doing authorised activity. We will stick to the test that we have today. It's important to put this in perspective. We've put the data out there in the letter. At the beginning of March, we had 37 investigations into regulated firms that were open. 22 are already in the public domain. 2 are about to get into the public domain. 7 we would not want to disclose because they're covert or sensitive for other reasons. 2 we would have kept anonymous, but we might have said something, but they'd have been anonymous because there's a criminal investigation. So there were 4 on our current portfolio where we felt there'd be a public interest in announcing. All 4 of those cases are cases where MPs or significant groups of MPs have asked us questions about what's happened, not dissimilar to situations that you've asked us questions about today, where we felt a modestly increased degree of transparency would have been appropriate to be able to respond to that accountability request and to give some confidence to your constituents. There wasn't consensus around that. There were divided views in Parliament. We're not moving forward with it. It was a very small number of cases.
So if this committee asked you about a specific issue, would you then decline to comment under the new position? Or do you feel like in a select committee environment you'd be able to answer and put that on the record?
So we have a specific gateway to Parliament. Dame Harriet asked me about a case involving Mr. Odey and his firm in the last Parliament, and I've always endeavoured during my tenure to be as open as I can be with this committee, because I see it as an absolutely fundamental mechanism of accountability and scrutiny. We have very far-reaching powers at the FCA, and we need to be demonstrably exercising them legitimately. You will want to think about the nature of questions you ask us, because in light of this debate, and as I said, the Public Accounts Committee was part of the prompt for this. We will always seek to be open, but you've seen the debate.
Thank you.
That's one of these issues that will probably come back again. Can I thank our witnesses very much indeed for their time? That's Ashley Alder, the Chair of the FCA, Nikhil, Rathi, the Chief Executive, and Sheree, who's one of the Directors, particularly dealing with authorisations. And thank you. The transcript of this session will be available on the website uncorrected in the next couple of days. And thank you for the marathon session. I think we will be discussing with you how we review your work in future, because it's sort of a lot to try and cram into one sitting, so we will be in conversation with you about that. Thank you very much indeed. Order, order.